Hi guys, Russell here. It's been a long time since I did a video for either on the fund or for the Substack. So I thought, let's do it. And actually, it's a very opportune time in the markets, I think, to think about what I'm trying to do with Brumby Capital and positioning and whether it's still an interesting prospect or not. And so, I updated the presentation. A lot of it's just carried over from before, but I think it's nice to see how the themes and markets have developed and have a little bit of look at, what's happened recently in the markets and with the fund and have a think about, whether the driving ideas behind Brumby still make sense. So let's get into it. For those of you who are new, this is a brief bio, but basically, I ran the Horseman Global Fund from about 2010. This is a positioning since 2006, but it roughly matches the positioning of the fund I ran at Horseman from 2006 as well. And basically, the big takeaway from this, spent most of my time being net short, and I'll talk about why I did that and how later on. But I generally had, if I could feel that there was a way to make money short, I'd like to do it. It sort of fits with my methodology of how I think about markets, which tends to be more on a relative basis than an absolute basis. So Brumby Capital, which is my current fund, I started in May because I thought there was a lot of downside to US equities, more like a bear market. That still may come to true. It hasn't really been true since we launched, but what I show you here is sort of positioning of both my PA portfolio that was being published on Substack, and then those are all the numbers in italics, and then the printed numbers, non-italic numbers, are the sort of real numbers from Brumby. Numbers in yellows are sort of estimates, if that makes sense, or unaudited numbers. The number for March is a big down number after two very big up months. There's, I think for me, because there was so much going on that month, I'm very uncertain about where exactly that number is, but it'll be a down, biggish number. One of the highlights, I guess, for the year was we were nominated for Best New Fund of 2025, probably right at the peak of recent performance, but there we go. That's interesting. And so that's where we are with that this product at the moment. So, what did I learn over the last few years before I gave back capital in the old fund and why I've started up Brumby Capital? So one of the big things is that politics is more important than economics, and I really do believe that, particularly now, even in this sort of Iran war issue, the politics of it is much more important than thinking about oil price and those sort of things. And we are definitely in an era of fundamental political change. The war in Iran is just part of that. There's change everywhere. And what I see is it sort of manifested itself in maybe bond markets, maybe gold, but not really in equities, although that's beginning to change. And really, we're in an era that I see as being pro-labor. That is, governments are trying to be much better for workers, if that makes sense. I also think we're sort of entering an era that's sort of anti-capital. But so far, particularly for US, it's almost entirely directed at foreign corporations. But we're starting again to see starting to see signs of change with that in some of the antitrust that even the Trump administration is starting to push through. And of course, we have tariffs to protect workers. But what we can see is that the governments see the way to political power is to take care of workers, to be more interventionist and more pro-labor. And I think that's is a theme that's slowly but surely working itself into financial markets. So if we look back at like 2011, 2016, which is when I was very deflationary, very bearish, it's because I think what I saw then was that markets were consistently wrong on bonds and currencies. So they never thought Japanese bond yields would ever go lower, and they always did. They never really understood what currency is doing. And for me, what I think is best understood is that the Washington Consensus was a very deflationary policy set of choices, allowing devaluation, allowing the free movement of capital, free movement of labor. It really kept a lid, particularly on real wages in the West, but it was a very deflationary policy because it was popular with voters until it wasn't. But markets never really understood that. And, they often used to short bonds, particularly JGBs, which came to be known as the Widowmaker trade, and they short yen. The yen would appreciate whenever the US got into trouble because it's all part of the Washington Consensus, right? We've now moved on to a new era, and those trades don't make sense anymore. But that's what we used to have, and that's what I used to look at and think about ways of attacking this sort of political outcome that markets was mispricing. So low yields, low JGB yields and currency crisis was actually part of the Washington Consensus. And they've sort of focused on three areas: trade liberalization, which reduced tariffs, allow competition, move government guarantees; privatization, which is move more government activity into the private sector; and financial liberation, so allow free exchange rates and let markets set bond yields and other things like that. And then what it grew out of the stagflationary 1970s. And what it did, and this graph is trying to show here, is that structurally it drove unemployment higher. If you want to create deflation, you need to have relatively higher unemployment. So you have this downward pressure on wages. And what we're seeing since really the GFC is unemployment is kept low. The COVID spike was special, but we can see that unemployment is kept low, which is why inflation pressures are much stronger, and why, if central banks want to control inflation, they need to keep monetary policy much tighter than it used to be. Now, what happened in the sort of Washington era, Washington Consensus era, is Japan would try and stimulate via lower interest rates, push down bond yields, devalue the yen. But because of the Washington Consensus, it would then mean other countries would devalue back against it. And so you never really could escape, deflation through currency devaluation. It just didn't work in a Washington Consensus area. And if you look at 98 and 2000, yen would depreciate first and the won would depreciate against it, which is why currency depreciation never really created the inflation that market expected. And you can apply very similar analysis to the US and Europe. The Euro crisis was really markets trying to devalue the periphery versus the core of Germany, but couldn't do it because of the euro structure, and it created the euro crisis. So that's how I used to manage money. So currency crisis were a constant feature. There's a flattening of wages globally and a deflationary trend. And this is why, and this is the graph here, from 1980s onwards, gold tended to underperform treasuries, right? Because gold is an inflationary asset, treasuries are a deflationary asset. So gold tended to underperform. There was some brief period from 2000 to 2010 where it outperformed and then it underperformed again, to everyone's surprise, right? And it underperformed in 1980 to 2000 because the Washington Consensus and austerity was what drove that. And so my model of investing is to look at the political trends, look at what markets are mispricing, and then I try and find assets that are correlated today but shouldn't be correlated in the future. So if you understood what I was saying about the Washington Consensus, a high inflationary nations with a lot of inflation like Brazil will tend to devalue against the US, which will then push US treasuries down. So like in the 2010-2011 period, we had this era where treasuries were positively correlated to emerging markets. So when treasury yields fell, treasuries did well, emerging markets did well because people saw it as a devaluation trade of the dollar devaluing. But actually, in reality, you couldn't really, in the Washington Consensus, would never allow emerging market wages to get too high. They needed to devalue back again, which would be deflationary. And so that's what I used to do, is be long treasuries, short EM. And that was great trade. And then we had the correlation break where we had treasuries are strong and emerging markets are weak. We made very good money in 14, 15. And that's the way I look at making money and how I think about things. So that's all background if you've never listened to me or thought about how I make money before. So where are we now in the post-Washington Consensus? So tariffs are on the rise. I know Trump had a setback, but I don't think that's going to be permanent. And tariffs are rising everywhere. Capital control, sanctions are more likely. Secure supply chains have become politically imperative, and the war in Iran emphasizes that even more. Fiscal spending is surging. I still think that is the case. And so for me, at some point, we are likely to see surging commodity prices and surging bond yields. And we got a taste of that last month with the war in Iran. And I think, we've seen it even back in the Liberation Day tariffs. We saw surging gold and falling treasury yields, or falling bonds and rising treasury yields. So this is, for me, something that's happening. So I think to raise real wages, not just normal wages, but raise real wages, at some point governments are going to have to reduce the pricing power of domestic corporations, i.e. try and get them to cut prices so real wages can rise. And so in this new era, inflation is structurally leading to gold outperforming treasuries. So this is a GLD-TLT trade you may have heard me talking about. I still think that's got room to move. This quarter, it's been a bit weaker than usual, and you can still see that slight flattening out. So it went up a lot and sort of came back. But to me, I still think this trade makes a lot of sense. And it's been mainly driven by gold. We haven't seen the weakness in treasuries that I would have expected as of yet. So at the moment, what we see in markets is the West, or the US, but the West is trying to keep corporates and workers happy. So that's a spending without taxation, if that makes sense. And so fiscal deficits are relatively large. And I think what we're going to see is that there'll be a break when government bonds are no longer considered risk-free assets, and there's already signs of that if you're looking at the markets. So I still like that trade. Are we in that era where government bonds are considered risk assets? Not yet, but it's coming. So I think this theory that I'm trying to trade on still makes a lot of sense. So the investment strategy is basically, politically, austerity is a dead policy. And so, if we do get a rally in treasuries, you're going to get more government spending because of that. I.e., if yields fall, then governments go, I've got more spending power, and they're going to spend it. And so GLD-TLT sort of captures that trade, and I've talked about that. And so I ultimately see a correlation between commodities and negatives being very deeply negative at some point. But at some point, government indebtedness will also become a corporate problem, either through corporate taxation or wealth taxation or anything like that. And so when I also look at the S&P 500 versus gold, I also like long gold, short S&P 500. That looks attractive to me. And you can see in this chart, it's just started to break a little bit higher. And I quite like that trade. So what I'm seeing is, another way of thinking about it, what I'm trying to say is that the sort of Washington consensus policies create huge pools of capital, which the world has become used to, the rise of private equity, sovereign wealth funds, huge trillion-dollar companies, because we have all this capital that's available. But what I see is capital becoming harder and harder to come by, and you actually see it in the markets everywhere. If you look for it, you can see it everywhere. And so for me, I try and balance bearish positions with bullish positions. So one area that I think would be successful would be Japanese banks, because they have large deposit franchises that have gotten derated in the Washington consensus era, and that should now re-rate higher because deposit franchises are cheap capital in a world where capital is becoming more expensive. And the performance of Japanese banks has been good last year, good this year. I think it fits in with this theme, and I quite like it. And like I said, the investment strategy also looks for short themes. So what we're starting to see is these pools of capital that particularly US corporates have called upon are starting to shrink. So if we look at Japanese foreign reserves, Chinese and Korean foreign reserves are all been declining to a degree, which means the amount of capital available for investing should decline and their costs should go up. So this is a chart of crypto from last year, but basically what we started to see is that bond yields gone up, people are starting to suffer financial losses. So the first signs of this is Norinchukin, which lost a lot of money and they cut their allocations of bonds. We're now seeing it in the private credit, private equity space. It was very predictable. Norinchukin was a big supplier of credit capital to that area. So as soon as the capital dries up, a lot of their business models don't make any sense. And we're starting to see that. And private equity I've been short of, and it's been a good short. The other thing that fundamentally is that there's a huge gap now in the valuation of key assets. So the Japanese 10-year now yields well above the S&P 500, which is something I've never seen in my investment career before. So now as S&P 500 seems like an unattractive asset, theoretically speaking. And we should see upward pressure on dividends, which is actually downward pressure on equity prices for the S&P, in my view. And so, being bearish S&P 500 to me makes a lot of sense. So the big question, I've sort of left it to the end of the chart because there may have been people who are not familiar with the product and want to know more about, is Brumby Capital still different? That's a good question because in March we had a drawdown, like most hedge fund strategies. In our defense, I made a lot more money in January, February than most funds. So a big drawdown in March is a little bit more defensible, in my view. So I think the thing is, what I was asking myself is that obviously positioning relative to Brumby had converged in the market a bit, but had the thinking converged, which is a bigger issue. If the thinking's the same, that's a problem. Positioning is always going to converge because of trend following tendencies and the way big hedge funds risk manage their underlying portfolio managers. They're basically forced into winning trades. So I've tried to think about that in a structure to see if I'm correct. So if we take Brumby as of March 1, I was long gold, long Japanese banks, short private equity, short treasuries. I was sort of neutral in the US dollar. I am long Swiss franc, but I don't have a brutally bearish dollar view. I think it probably does weaken, but it's not the same sort of dollar devaluation trade you see elsewhere. Emerging markets, I'm neutral. I don't see rising bond yields in the West being particularly good for emerging markets. When you do look at emerging markets, most of the performance has been tech driven. You can have different views on that. And I'm bearish in the S&P 500. And the theme that organizes all of those trades is a rising cost of capital driven by more and more of GDP and income flowing to workers. If I look at the macro funds that I know, and this is from just talking to investors out there, generally they were long gold, then neutral in Japanese banks. I think some may be long, not a big trade for them. Private equity, I don't perceive a huge short position there. I could be wrong, but I don't. Treasuries, again, I think people were bearish bonds, but I think the positioning was much more neutral on that. Very short US dollar, I think, for the macro community. Very long emerging markets for the macro community. And the S&P 500, I would say there was a neutral view coming into March 1st with my neutral to long, if anything. And then for the trend followers, the mindless guys who just basically copy off other people's homework, they were definitely long gold. They're probably long Japanese banks, long Nikkei anyway. It would be neutral in private equity, is mixed signals. Treasuries, again, neutral. US dollar, they would have been short because it was trending poorly against all the major currencies. Long emerging markets because tech's gone well, they don't care about it, they just follow it. And they would have been maybe neutral to long in the S&P 500, and that's just trend following. So what I'm trying to say is that I think there was definitely overlap in gold, and you could see that. There was definitely some overlap in at least Japanese equities or Japanese banks, which I get. On the private equity, which actually has been a great short this year. I think I'm alone in that. I think that's where we've generated a lot of alpha. Treasuries, I'm short, going to be a little bit of alpha, not too much. On the US dollar, we're sort of neutral, but I think that hurt a lot of the big macro trend funds. Emerging markets, I'm sort of neutral. I think that probably hurt some of the big funds out there. S&P 500 bearish. I think that's helped us again to generate alpha. And so what I'm trying to say is that, yeah, we saw weakness in March, but, in part because we just made so much money in some themes, we drew a drawback or a pullback. Well, but I don't really think positioning will always converge. You have a winning trade, everyone's going to pile in. But I don't think thinking has converged. I think the thinking that most people have is very different to thinking that I have. So anyway, I think it's okay. So, is Brumby different? So I'm long gold as a hedge on monetary policy being too loose. right? I think macro funds see it as a weak dollar trade. I'm long Japanese banks because I see a rising cost of capital should revalue the deposit franchise. I would say the macro guys see it as and trend guys see it as a cyclical trade. I'm short US stocks. I'm pretty alone on that one, and it's alpha generating. I'm short US treasuries. I think short positions by macro and trend followers is much more than it used to be, and that's been an okay trade. And ultimately, for me, I think a lot of people look at it as a cyclical trade. I see it as a political trade. And for me, I'm still targeting like a 10% on long-dated US treasuries. I don't really feel that is a consensus view in the markets anywhere. So I think Brumby is still different. But in the markets that we operate in now, it's difficult to have good positions that stay independent of markets for very long. You're always going to have trend catching up. And I think that's something we can try and manage, but it's very difficult. So in summary, I think what I'm trying to say is that for brief or in long, for reasonable periods of time, markets, I think, can misunderstand the financial implications of political decisions, if that makes sense. So from like 2011 through 2016, I think markets really misunderstood the currency and bond implications of Western austerity. And that, for me, for the way I think, you could arbitrage the currency risk within equities, which was much more cheaper than direct currency shorts and much more effective. So I'm looking at experience, and I'm looking at like the markets today in 25 and 26, and I'm saying markets are underestimating the rise in inflation and bond yields, and we're starting to see that be represented in some equities, particularly like private equity, and I'm seeing other places to do stuff there as well. So what I think you can do is you can short equities and arbitrage to the risk of high yields, or actually you can also buy like Japanese banks as an arbitrage on high yields as well. And I say in the States in particular, the long dated equities are priced in a world of low bond yields that I don't think is going to exist, if that makes sense. And I think we can run this strategy until this correlation break is realized. So what we see is soaring commodity prices and soaring yields or falling bonds. And that will be when, the strategy that we're running should be really making a lot of money and producing a lot of alpha. And that'll be the time to return capital. And I think nothing's changed there, even with what's happened in March. It's been a shock, and we saw a lot of consensus positioning get wiped out, but the thinking still makes sense. And the positioning now should be cleaned out. Hope that makes sense. Stay safe, and we'll talk again soon.